Today, we're diving into some exciting news about a significant jump in housing starts for the month of October, as reported by OnSite magazine. According to the Canada Mortgage and Housing Corporation, the total monthly seasonally adjusted annual rate of housing starts across Canada saw an impressive increase of 8% in October, reaching 240,761 units. This was a rise from 223,391 units in September. While this growth is certainly noteworthy, it did not quite impact the 6-month trend in housing starts, which remained flat at 243,522 units for October. Breaking it down further, in Canada's urban centres with populations of 10,000 or more, there were 188,567 actual housing starts from January to October of this year. This data highlights some interesting regional trends. The Prairie provinces, Quebec, and the Atlantic provinces have seen higher activity in housing starts, whereas Ontario and British Columbia have experienced declines across all housing types. However, the increases in the monthly seasonally adjusted annual rate in Toronto and Vancouver were promising, as these cities were key drivers of the national increase in October. Despite the positive signs in Toronto and Vancouver, Canada's chief economist at the Canada Mortgage and Housing Corporation, Bob Dugan, pointed out that the current level of housing starts is still insufficient to address the affordability challenges in urban centers across the country. It is a situation that requires continued attention and action to ensure that housing supply can meet demand, particularly in these high-density areas. Looking at specific cities, Montreal has shown a notable recovery with a 12% increase in housing starts from January to October compared to the previous year. This recovery comes after a historically low level of new home construction in 2023. On the other hand, Vancouver has seen an 18% decrease in actual starts compared to last year's record-high numbers. Toronto, too, has experienced a decline with a 21% drop in year-to-date housing starts compared to 2023, although last year was exceptionally high for housing starts by historical standards. These statistics paint a complex picture of the housing market in Canada. While some areas are seeing growth and recovery, others are facing declines, reflecting the varied economic and market conditions across the country. It is crucial for policymakers and industry leaders to consider these regional differences as they plan for future housing needs. In a remarkable turn of events, Canada's housing market experienced a significant upswing last month, with home sales reaching their highest point in over 2 years. According to the Canadian Real Estate Association, there was a 7.7% increase in transactions from September, bringing October's sales to levels not seen since April 2022. This surge follows the Bank of Canada's recent interest rate cuts, which have played a crucial role in reigniting buyer confidence. The Bank of Canada cut interest rates in October, marking the largest reduction since March 2020. This move is part of a broader strategy to stimulate the economy, with lower borrowing costs making it more feasible for prospective homebuyers to enter the market. As anticipated, this has had a direct impact on the housing sector, boosting buyer activity significantly. Sean Cathcart, a senior economist at the Canadian Real Estate Association, described the increase in home sales as an October surprise. With further rate cuts potentially on the horizon, the expectation is that this growth trend in the housing market could continue into next year. Cathcart suggests that the October figures may provide a glimpse of what the market might look like in the coming spring, when mortgage rates are expected to approach their projected lows. Interestingly, despite the surge in sales, home prices across Canada remained stable. The benchmark price for a Canadian home saw a slight dip of 0.1% in October, settling at $716,800. This stability in pricing suggests that the increased activity has not yet resulted in significant upward pressure on home prices, which could further encourage hesitant buyers to make their move. James Mabey, chair of the Canadian Real Estate Association, noted that the strong sales figures indicate that buyers have been present in the market since interest rates began to decline earlier in the summer. However, many were waiting for the right properties to become available, a trend that finally materialized in September. This dynamic is expected to continue as more buyers return to the market, drawn by the combination of lower rates and increased inventory. The federal government has recently announced a substantial investment of $262.2 million to construct 691 new homes in northern and indigenous communities throughout Ontario. This announcement was made by the Honourable Patty Hajdu, who serves as the Minister of Indigenous Services and is also responsible for the Federal Economic Development Agency for Northern Ontario. The event took place at the North End Community Centre in Thunder Bay, adjacent to the 1040 Huron Avenue project, which received $4.8 million to develop 24 one-bedroom apartments. These apartments will be managed by Ontario Aboriginal Housing Services, adopting a For Indigenous by Indigenous strategy for transitional housing. Located near schools, parks, and public transit, this initiative aims to provide accessible housing options for Indigenous communities. This effort is part of the broader National Housing Strategy, a decade-long $115 billion plan designed to ensure more Canadians have access to affordable housing. The strategy includes the Affordable Housing Fund and the Rapid Housing Initiative, which prioritize projects that cater to those most in need, such as seniors, Indigenous peoples, and individuals experiencing homelessness. As of September 2024, the federal government has committed over $57.5 billion to create more than 156,000 housing units and repair over 297,000 existing units, focusing on those facing the most significant housing challenges. Minister Sean Fraser, who oversees housing, infrastructure, and communities, emphasized the importance of these investments, stating, "Everyone deserves a place to call their own." The Affordable Housing Fund provides funding through low-interest or forgivable loans and contributions to partner organizations, supporting both new construction and the renovation of existing housing. This $14.6 billion program under the National Housing Strategy prioritizes projects that assist people in urgent need, including families fleeing violence and veterans. The Rapid Housing Initiative is another critical component of this strategy, managed by the Canada Mortgage and Housing Corporation. It facilitates the rapid construction of new housing and the acquisition of existing buildings for conversion into affordable units. The initiative has surpassed its targets with its third phase, launched in 2022, which expects to create over 5,200 new homes. Notably, a significant portion of these homes are designated for women and Indigenous peoples. The recent funding announcement for Ontario is a testament to the government's commitment to addressing housing needs across the province. Projects like the one in Thunder Bay are pivotal, offering a template for how communities can collaborate to provide housing solutions that are culturally sensitive and deeply rooted in the needs of Indigenous populations. As these developments progress, they will not only provide shelter, but also foster community growth and resilience. The Canadian housing market is witnessing a resurgence as homebuyers re-enter the scene, according to the latest data from the Canadian Real Estate Association. This renewed activity follows a series of interest rate cuts by the Bank of Canada, which have encouraged buyers to step off the sidelines. October saw a notable 7.7% increase in transactions compared to September, marking the highest level of activity since April 2022. Despite this surge in sales, the benchmark home price saw a slight decline of 0.1%, settling at $716,800. Leah Zlatkin, a licensed mortgage broker and expert at lowestrates.ca, highlighted that the combination of rising sales and a decrease in new listings is setting the stage for increased competition. With new mortgage rules set to take effect on December 15th and further anticipated rate cuts from the Bank of Canada, the market is expected to heat up even more. Zlatkin noted a significant rise in pre-approvals, as many buyers are no longer waiting for interest rates to drop further. Homebuyers who were sitting on the sidelines are now actively engaging, weighing their options, and asking critical questions about whether fixed or variable rates best suit their needs in this evolving environment, she explained. Victor Tran, a mortgage and real estate expert at Rates.ca, echoed similar sentiments, suggesting that the housing market's pickup is beneficial for both buyers and sellers. He pointed out that if the Bank of Canada implements another significant rate cut in December, it could shift buyer psychology, leading to a busy winter season. Tran emphasized that many buyers have pre-approvals and are waiting for the right moment and property to make their move. Once the tide turns and buyers enter the market en masse, we will likely see the market heat up quickly and a corresponding rise in home prices, he added. While the national average of new homes being built across Canada has seen a steady increase, Ontario is lagging behind in this upward trend. A recent report from the Canada Housing and Mortgage Corporation highlights that the seasonally adjusted annual rate of total housing starts has seen a boost in the past few months. In September of this year, the national housing start average was approximately 223,391 units. However, by last month, this number had climbed to 240,761 units, indicating an 8% increase. In urban centers with populations exceeding 10,000, there were 188,567 housing starts recorded from January to October 2024. When compared to the 187,722 starts during the same period in 2023, the difference is relatively small, with only 845 additional units this year. This data suggests that while there is growth, it is not as substantial as some may have hoped, particularly when considering the need for more housing across the country. The report underscores an asymmetrical trend where certain Canadian provinces are experiencing growth while others are facing declines. Specifically, the Prairie provinces, Quebec, and the Atlantic provinces have shown higher activity in housing starts. In contrast, Ontario and British Columbia have experienced declines across all housing types. However, the monthly increases in the seasonally adjusted annual rate in Toronto and Vancouver offer a glimmer of hope for these provinces. Bob Dugan, the chief economist for the Canada Housing and Mortgage Corporation, commented on these trends, noting that despite the uptick in some areas, the current level of housing starts remains insufficient to address the affordability challenges in Canada's urban centers. Despite these results, we remain well below what is required to restore affordability in Canada's urban centers, Dugan emphasized. This highlights the ongoing need for strategic policies and initiatives to boost housing supply where it's most needed. In recent news, 2 Canadian cities have been highlighted as being at risk for a significant rise in mortgage arrears. This information is particularly concerning given the current economic climate and the potential for increased financial strain on homeowners. The cities in question are Edmonton, Alberta, and Regina, Saskatchewan. These cities have shown signs of economic stress, which could lead to difficulties for homeowners in keeping up with their mortgage payments. According to the Canada Mortgage and Housing Corporation, the risk of mortgage arrears is closely linked to local economic conditions. In Edmonton, the economy has been affected by fluctuations in the oil industry, a key driver of employment and economic activity in the region. The volatility in oil prices has had a ripple effect on the local economy, leading to job losses and financial instability for many residents. This economic uncertainty is a significant factor contributing to the potential rise in mortgage arrears. In Regina, the situation is slightly different but equally concerning. The city has experienced a slowdown in economic growth, which has impacted household incomes and employment rates. The agricultural sector, a major component of Regina's economy, has faced challenges due to unfavorable weather conditions and fluctuating market prices. These factors have combined to create a precarious financial situation for many homeowners in the area. The Canada Mortgage and Housing Corporation has emphasized the importance of monitoring these trends closely. They suggest that policymakers and industry leaders need to be proactive in addressing the underlying economic issues that are contributing to the increased risk of mortgage arrears. This could involve implementing targeted economic support measures to help stabilize these local economies and prevent a surge in mortgage defaults. While the situation in Edmonton and Regina is concerning, it is important to note that these are not isolated cases. Other regions across Canada could also face similar challenges, particularly if economic conditions do not improve. It is crucial for both homeowners and lenders to remain vigilant and explore potential solutions to mitigate the risk of mortgage arrears. This might include financial counseling, restructuring of mortgage terms, or other supportive measures to help homeowners navigate these uncertain times. Chicon Developments, a Brampton-based real estate developer, is currently embroiled in financial difficulties, facing 2 receiverships and 2 power of sale proceedings. These legal challenges are impacting 4 of their properties in Ontario, which include a retail plaza, a planned condominium project, a seniors housing project, and an industrial property, all located in Brampton or Caledon. This situation has brought significant attention to the ongoing challenges within the real estate sector, particularly for developers navigating financial and market pressures. Founded in 1983, Chakan Developments is a family-run business now in its third generation, boasting over 4 decades of experience with projects across North America and Europe. Despite its rich history, the company is now facing serious financial hurdles, as evidenced by recent court filings in the Ontario Superior Court and various property listings. The most notable of these is the receivership order against Chakan Strawberry Fields Inc., related to the Strawberry Fields Plaza in Caledon. On July 19th, the Ontario Superior Court granted a receivership order against the company for their commercial property known as the Strawberry Fields Plaza, located at 12,550, 12,560, and 12,570 Kennedy Road in Caledon. This action was initiated by First Source Financial Management Inc., a private mortgage lender, due to a default on a $17 million first-ranking mortgage. The mortgage agreement, which commenced in December 2022, required Chakan to make interest-only payments, but they defaulted in April 2023, leading to a series of legal and financial complications. The financial troubles for Chakan did not end there. The Strawberry Fields Plaza has accumulated several encumbrances, including construction liens and a second-ranking mortgage charge, along with significant property tax arrears owed to the town of Caledon. The property's current financial liabilities have prompted its listing for sale by Leonard Commercial Realty, though without an asking price, highlighting the urgency of the situation. Adjacent to Strawberry Fields Plaza is another Chakan project, the Strawberry Fields Residences, which was intended to be a 4-story building with 158 condominiums. This project, too, has been affected, as it is now listed for sale via power of sale. This development was initially part of the Peel Affordable Rental Incentives Program, receiving over $7 million in funding for 14 rental units. However, it seems the project's financial and development hurdles have stalled these plans. The financial distress extends to another Chakan property, the Jeevan Niwas project at 9664 Goreway Drive in Brampton. This seniors housing project was planned as a premium retirement village with various living units for seniors. Despite its promising concept and an initial groundbreaking attended by local officials, the project is now for sale via power of sale, with an asking price of $14,500,000. This reflects the broader financial strains facing Chakan developments. More recently, in August, another receivership order was granted against Chakan Holding Corp. For an industrial building in Brampton. This was at the request of 2,439,656 Ontario Inc., and MS Capital Corp., who hold a second-ranking mortgage on the property. The cumulative financial pressures on Chakan developments underscore the challenges that even long-established real estate companies can face in a volatile market environment. Chakan Development's current predicament serves as a cautionary tale for the industry, illustrating the potential pitfalls of financial mismanagement and the importance of strategic planning in real estate development. While the company has not publicly commented on the situation, the ongoing proceedings and property listings suggest a need for significant restructuring or potential liquidation of assets to address their financial obligations. As we wrap up today's episode, let's delve into the latest insights on Canada's inflation outlook. According to a recent report, the inflation rate in Canada is expected to see a slight uptick for October, reaching 1.9% from September's 1.6%. However, economists are quick to point out that this is not indicative of a reversal in the broader trend of easing inflation pressures. This minor rise is largely attributed to the increase in gasoline prices, which have climbed from $65 to $75 per barrel, contributing to the higher consumer price index. Claire Fan, an economist at the Royal Bank of Canada, emphasizes that the underlying trend still points towards easing inflation. She notes, "We're expecting headline inflation to go back up to 2%, but just like how it dropped down to 1.6%, it's mostly an energy story." This suggests that despite the October uptick, the broader story of progressively easing inflation pressure remains intact. Meanwhile, core inflation, which excludes more volatile categories like energy and food, is expected to remain stable or even decrease slightly. the Royal Bank of Canada projects core inflation to decline to 2.2%, down from 2.4% in September. Similarly, the Bank of Montreal forecasts it to hold steady around 2.4 to 2.5%. Economists highlight that while property taxes and shelter costs are contributing to core inflation pressures, these influences might be offset by declining mortgage interest costs following the Bank of Canada's recent rate cuts. Benjamin Reitzes, the managing director of Canadian Rates and Macro Strategy at the Bank of Montreal, described October as a bump in the road for the downward inflation trend. He explained that although prices did not surge, base effects are challenging, suggesting that both headline and core inflation will see modest acceleration. Housing costs continue to be a significant focus area. Elevated property taxes have pushed shelter costs higher, but the recent rate cuts by the Bank of Canada, which lowered the benchmark rate to 3.75%, are gradually easing borrowing costs for homeowners. On the rental side, inflation remains high, with rents rising at their fastest pace since the 1980s. Desjardins economist Maëlle Boulay-Prézeau noted that rental inflation averaged 8.3% in the third quarter of 2024, but expects it to slow down as population growth moderates and unemployment rises. Canada's inflation dynamics are quite different from those in the United States, where strong government spending and a robust labor market have pushed inflation higher to 2.6% in October. In contrast, Canada's softer labor market and weaker population growth are helping keep inflation in check. However, these factors have also contributed to downward pressure on the Canadian dollar, which is currently at its lowest level since 2020. Looking ahead, there's some uncertainty surrounding the Bank of Canada's next move. The Bank of Montreal predicts a modest 0.25% rate cut in December, whereas the Royal Bank of Canada anticipates a more aggressive 0.5% reduction. Claire Fan suggests that given the current weak conditions, the Bank of Canada might opt to front-load any easing to provide support to the economy as swiftly as possible. That wraps up our discussion on the potential rise in inflation and its implications for Canada's economic landscape. It's clear that while there are challenges, the overarching trend towards easing inflation pressures continues, offering some reassurance to both policymakers and consumers. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.